Hey, good afternoon, everyone. Thanks for coming in. This is Module 7 of our 10-part series. And what I wanted to do today, first of all, I'm going to be looking a lot at okay, now we're ready to go. I'm going to be looking at information that moving averages can tell us. Now, I've gotten some feedback where, traders don't want to use any indicators, but I think that generic indicator analysis is an important part of what we do, and so we're going to be looking at some generic indicators. Now, the thing is, we're going to be looking at the modified 15, and since there are people who took the course that are not necessarily associated with our software, what we'll do is at the end of the course, I'm going to make the modified 15 available to anyone who doesn't have our software. So you won't feel like you're listening to this webinar for nothing, or this lecture for nothing. And what I wanted to do is I wanted to show you some really powerful information that the modified 15 can give you that you can see if you look carefully. And it's one of the reasons why it's hard to trade multiple time frames, and it really speaks strongly for how focusing in on one and only taking the highest or the safest trade, and maybe look for 1 or 2 trades a day, may not be the best strategy. And let me show you the first slide. Now, here's the first slide, and what I wanted to show here, and I really did a lot of work on the slides to find these formations, and the fact of the matter is they occur fairly frequently. The problem is, if you're not really focused in on your chart, you're not going to see the trade. And here's what I wanted you to see. Now, this is a pattern that recurs over and over again to give you a picture of a really low risk, high reward trade. And it's a trade out of consolidation that normally you would not take. Now, I was going to look at multiple time frame trading, but I really didn't think that was as advantageous as this. And what you can see here is that we've got a long period of consolidation, and price essentially is moving sideways. But if you look at the modified 15, it starts to fall before price starts to fall. Now, everybody talks about indicators being lagging indicators, but the modified 15 is a really unique indicator. You can see it turns from yellow to red on really what is essentially sideways price action, and it continues to fall even on an up candle. And on this up candle, it falls even more. On this down candle, obviously, it's going to fall. And you can almost see that break of the 50 coming and price firing down on this trade. So it's really giving you the heads up that consolidation here is going to break to the downside. It's just a question of when you're going to take the short trade, because you're not going to get a consolidation signal, because the signal just doesn't align with the inputs on the consolidation indicators. It's something that you have to see. And you can see, if you look really carefully and watch the modified 15 fall as price moves sideways, you could have gotten yourself a really nice short trade. This is a 13 range NQ. Now, here's the same thing. You've got 1, 2, 3, 4 candles, And all this is doing, now this is a trade that we would take anyway. I didn't want to put in any indicators or put in a consolidation signal, and you probably would get a consolidation signal. But you can see, even on sideways price action, the modified 15 continues to fall. I mean, its trajectory, now it sort of smooths out a little bit, but its downslope never stops. Now, I wanted to talk a little bit about the modified 15 and why, you know, when I do these, it really reminds me of how important some of these indicators are and how the analysis. Now, because we're in GoToWebinar and not Evergreen, what I'm going to do is I'll take all the questions at the end. So I'm sorry, but I think it's just going to be a little bit easier because it's tougher to see the questions here. So what I want to make you aware of is what the two components of this indicator are and what they represent. One of the components is the ADX-ADR line, and that's a measure of volatility. So when the line is red, now volatility can be to the downside or to the upside. And I'm trying to think of the best way to explain it. When the ADR or ADX line goes, when the ADR ADX component of this line goes red, all it's telling you is that volatility in this market is increasing, even though it may not be seen in the current candle formation. Remember, the ADR ADX is actually an indicator, and it's a measure of volatility. Now, if volatility continues to rise, and as the slope of the modified 15 continues to fall, or the slope gets bigger, either to the downside or to the upside, it means that volatility of the trading instrument is continuing to rise. The color is telling you, is giving you an assessment of momentum and is telling you what direction to leverage that volatility. So when the modified 15 is yellow, it's giving you two pieces of information. One, there's really no significant volatility present in this instrument, and there's not enough momentum present in the market to give you a direction in which to leverage the volatility if the volatility was present. Now, in order for the modified 15 to go red, you need both components to align. You have to have increased volatility, and you have to gain momentum in the same in a direction. Now, you can see that they're directly related. I mean, as you get a nice movement in price, volatility is going to increase, and obviously momentum is going to increase. That's why it's so much more, it's a lot more dangerous to trade the market when the modified 15 is yellow, because it's more than just a moving average. It's also a measure of short-term volatility. And it also, obviously, like every indicator, it gives you an assessment of momentum, but this has been smoothed. And the component that smooths it is the ADX-ADR line. And the ADX-ADR component keeps, I mean, if you look at a 15-period simple, or you look at a 15-period exponential, they're rarely flat. They go up and down, and they track price fairly closely, the exponential a lot faster. We talked earlier about why we don't use any indicators that use second-order derivations in order to create a line. And that's because the market doesn't move in a second-order manner. Nothing here works to the power of 2 or to the power of 3. So I don't think that an exponential or any indicator with an exponential in it has any validity in predicting in predicting future price. And I hope that's not confusing. We don't want to look at anything with an exponential in it. These are all first order derivations, and we have to keep them first order. So if we look at a 15-period simple, it's going to track price fairly closely. And if I opened up the NinjaTrader and showed it to you, you would see that the 15-period really does, it's almost never yellow. I mean, if we put the yellow color in it to represent a fairly flat slope, you'd almost never see it. It's the ADR-ADX component of this indicator that creates this yellow line, because when volatility has flattened out and there's not enough volatility to trade the market, it's telling you to stay out. So any time that you get a trade, and you can trade a yellow 15, we used to have a rule for a long time. We never traded on a yellow modified 15. It was a hard and fast rule that we never broke, and it's one that maybe we should go back to, because there was a trade yesterday I took on crude oil that was a perfect trade on a yellow modified 15 that went nowhere. And the modified 15 was telling me there was not enough volatility on crude nor momentum on crude to leverage any particular setup, no matter how good it was from a price action standpoint. So what I wanted to show you again here is how, if you're going to make an assessment of the risk associated with the trade and price action moves sideways, but the modified 15 continues to fall, it's telling you that momentum is continuing to the downside and volatility is continuing to gain. You're gaining volatility even though price is moving sideways, and this is going to be a really high probability winner. Now, we look all the time at what do we do on a multi-candle retracement. Multi-candle retracements are very, very tough to trade. But what I did was I took a look at what happens on most multi-candle retracements. Most multi-candle retracements flatten the modified 15. They're going to deflate momentum to the upside and take the sail out of it and bend it. But what if you pay real close attention to the modified 15 on this multi-candle pullback, you see that throughout this formation, from here all the way through and up, volatility and momentum continue to rise even though you have a 2-candle pullback, telling you that a long entry here is really not a risky entry. It's really a good entry. So you can see you can actually leverage the slope of the modified 15 on a multi-candle pullback if it stays the same slope. If it starts to flatten out, then you have to be very careful. But if it continues to rise like this, and you can see you've got this little jag here, but to no appreciable degree did this trade, did price action here bend this indicator to the downside. It's still moving up, and it tells you there's your nice long trade to the upside. This is just another example of a very strong slope to the downside. And this is a long period of consolidation. You've got 4 candles and a piece of this candle. And this slope doesn't budge at all. I mean, I was pretty impressed when I saw that you just don't get any flattening of the slope. Once it starts, it continues and it just doesn't give up. And so what you've got here is a great opportunity to take a short out of consolidation with extremely low risk. And what I see is when we take trades way at the bottom, that modified 15 starts to flatten out. Now, obviously, one of our jobs to do later on is to try to correlate the slope of the modified 15 with the probability of getting a winning trade, and I think we're going to find a really nice correlation. So when the slope of the 15 is flat or flattening, then you're going to have a problem with your trade. But when you have this kind of price action, and the modified 15 just continues down hard, you've got yourself the opportunity for a nice trade. I also look, I'm going to show you some other things that I noticed. The other thing too is when price peels off the 15, you have to be very, very careful about a trade. You want to stay tight to resistance or tight to support on a long. But this is really telling. Now here's another example of what you would consider to be a risky trade. And again, this is why if you don't pay close attention to the instrument you're trading, it's very, very hard to pick these things up. Now price falls, obviously, and it turns the modified 15 red because you do have an increase in volatility and you do gain momentum to the downside. But then it's important to watch what happens when price flattens out. And what you do is you actually get a down curve on this flattening price action. And that down curve gives you the opportunity to take this break to the downside. Now, we used to have another trade configuration. And the trade configuration would be if the 15 was falling above the 50, and it was above the 50, and the 50 was flat or red, you could take this break to the downside. Now, we abandoned it because, for one thing, the tighter the modified 15 is to the 50, the higher the probability it was to trade. And the other thing that we never looked at was to make sure that the slope of the modified 15 continues to fall throughout this price movement sideways. It is hard to see, but as this candle matures to the downside, if you see that modified 15 starting to bend down, and in the upper left-hand corner you see we have the slope degree. Now it's not in degrees; it's in a numeric. It's a numeric, and we eventually we're going to convert that to degrees, but it really doesn't make any difference. You're going to see that number get more negative. It tells you that you have a much lower risk potential break of the 50 on a falling 50 and a falling 15 and a flat 50. Now, these are the kind of trades that if you don't pay attention to your trading instrument, you're just not going to see. There were other trades that I saw where there was a lot of chop at the 50, but the modified 15 continued to fall. The problem here was you just didn't know which candle to take to the downside. And out of the many trades I saw, you could have taken a trade in chop, gotten stopped out, gotten back in, and then gotten the winner. So what I did was I narrowed it down to simply trades that consolidated at the 50 and moved sideways to give you an idea of where the best place is to take the trade to the downside. It's not a system-generated signal. You have to create the entry. I just put that arrow in on my own, but that gives you the heads up that you may have a great trade coming. It's another way of leveraging the fact that this is an ADX ADR combined with a 15 period. Now, this is I wanted to show you another candlestick formation that you don't see very often, but when you do see it, it's actually very, very helpful. Now, there are two things that you can see, and one is pretty obvious. The modified 15 is heading up, strong slope to the upside. It has not crossed the 50, so we know that the risk associated with the trade is going to be higher. But this is called three white soldiers, and it occurs here. Now, if you read about three white soldiers in Stevenson's book, he always tells you that you have to pay attention to all the other independent variables, all the other issues associated with it. You just can't take these candles. But what these three white soldiers do is they break the 50, you get a quick retracement, and the continuation up. And the three white soldiers tell you that the bulls are really in control of the market, and all you're doing is combining this configuration with the pullback and the fact that the modified 15 is continuing, and the modified 15 here is ripping to the upside. This is a significant slope degree here. So now these three white soldiers take place on a yellow modified 15. They never turn the market. And these are four. I mean, you're really looking for three. The pullback and the continuation, the modified 15 ripping up. Very, very nice formation. Right out of Japanese candlestick formation dogma that gives you a very, very nice entry, even though the 15 is below the 50, and under other circumstances, you may not pay attention to it. And another reason why you have to pay really close attention to the chart that you're trading, or at a first glance, you might just say, okay, the 15 is below the 50, I'm going to wait for that 15 to cross, and you're going to miss a very, very low risk entry. Now I don't know how that got in there. Oh, here's how this got in there. I actually put it in there for a reason. You look around all the time, and it's a little bit out of order, but it's still important, and I have quite a few slides that are going to demonstrate this. What you're looking for here is what is the probability of a break of support and taking a trade into a pivot or into a market profile area? Is there any way we can predict that the power of the move is strong enough to break support or resistance? And I do believe that ultimately when we get around to it, and it's not going to be that far off, it's going to be totally based on the slope degree of the modified 15. And what I wanted to point out here is, again, you have an enormous period of sideways consolidation. And you know that sideways consolidation, the break out of consolidation, is a very, very powerful move to the downside, because you've trapped all these counter trend traders in the long position. Now, when you get the consolidation signal, you may hesitate. I might hesitate because I'm trading right down into a confluent low volume node in the value area low, and we can never be sure that the price is going to break it. But if you look at the modified 15 throughout the sideways movement, it just continues to press down. Volatility and momentum are continuing to fall, even though price is sideways. And I'm telling you, this is all the ADR, ADX component of this indicator. If this was a simple 15 period, this thing would flatten out like a pancake as faster than you could believe it. I mean, it would be bending upward and not providing you with any predictive value on the future movement of price. And I'm going to show you what happens when you hit pivots with significant slope on the modified 15. And again, without beating this dead horse, it goes back to really paying tremendous attention to your trading chart, because the indicators, and in this case we're just looking at the 50 and the 15, and this area of support can be anything. It could be a pivot. It doesn't have to be market profile. Excuse me, the question is whether or not you can consider taking a trade into an unbroken area of support. Now, the reason I put this slide in here is simply because I really didn't put it in for the entries. What I put it in for was the potential break of this pivot. And if you look at the modified 15 on this move up, it just never gives up. It is really pushing up hard. Now, I actually put it in for two reasons. The first is, would you take a long trade on a small candle body? Now, it's a very, very risky trade to take. And if you stay with our rules, you really need a piercing candle in order to take the entry. But what I wanted you to see was when the modified 15 has gotten all this momentum to the upside, intrinsic volatility in this market is rising. It makes this a lower risk trade. You're going to get this entry anyway. Now the question arises is whether or not you're going to make an assessment of whether or not this upside pivot is going to break, or whether or not you're going to take profit at the pivot. And really, if you look at the modified 15, it is moving up so strongly, and there's so much momentum and so much volatility that you could make the assessment that this pivot is going to break, and it does. Now here's the same thing here. I looked hard and fast for this slide, but when I started looking for them, I began to find them over and over again. Now here, the modified 15 is yellow, and what it's telling you is that there's no volatility. Forget price action. This is really doing a really accurate assessment of volatility in the market. So what happens when price comes down to the pivot? It bounces. Price comes down to the pivot, it bounces. Price comes close to the pivot, it bounces. Because it's moving down into the pivot with no volatility and no momentum. Now, if you took this roll here and took this trade short, you could potentially take it. I wouldn't take it. But the point is, you're not going to trade into this pivot when there's no volatility and there's no momentum. And look what happens here. Look at the slope of the modified 15 when price approaches this pivot. It's really significant. And price just smashes through the pivot. So you can compare and contrast the difference of price hitting the pivot here and price hitting the pivot here. Bounce, bounce, close, bounce. You know, it's trading off, but it doesn't break it. Here it comes right through with exactly the same kind of setup as you have here, except here it's associated with significant slope, and that slope represents momentum and volatility, and it smashes right through the pivot. And this is a significantly big pivot. Here's the same thing again. Now, if you took the trade right here, you're still going to get your first target. Are you going to take your profit at the pivot, or are you going to consider it to be a low-risk proposition to let price move through, assuming that you're going to get a break? And you are going to let price try to break it based on the slope of the modified 15. And that slope is real significant. Now, same thing here. Let's hang on 1 second here. Okay, same thing here. Now, this is a multi-candle push-up and a very risky trade right back down into a pivot. Now, the modified 15 is really pushing down hard on this entry short. And you can see it just walks right through the pivot. You can see the kind of predictive value the slope of the modified 15 does, because it's a dual component indicator. It's not just a moving average, but it's also a measure of volatility based on an ADR-ADX formula. So it's very, very helpful in assessing risk on a given trade. Here's the same thing that happens again. Now, and really the only thing I wanted to show here was how price comes down and comes right back up to the pivot, and our anticipation of a break of the pivot is nil because we've got the flat modified 15. The price action here, although it's significant, we've got a whole bunch of candles up here. You need momentum and you need volatility to turn this red. And you can see it won't turn red. And so your anticipation is not a break of the pivot, but a rejection of the pivot. Now, this is just the opposite of the 3 white soldiers. This is the 3 black crows. And it's coming off of an area of resistance. You get the early retracement. This prior move down tells you that bears are firmly in control, and you can take the continuation trade to the downside. This is not a candlestick formation that you necessarily see that often, but when you see it and you catch it, it gives you a real low risk, potentially high reward trade. Here's again the 3 white soldiers. Up, back, and up. Let me just see where I am here. second. Okay. Now I'm going to open it up to questions. This is a little bit of abbreviated. This actually, you know, sometimes I put in 20 slides and it takes me an hour and a half. This time I put in 20 slides and it only took me 40 minutes. So I'm going to open it up to questions and see if there are any. It went a little bit shorter than I anticipated, but I really think the points made are really, really significant. Now the fact that I have finished early gives me a rare opportunity to answer a whole bunch of questions. Let me see if there are any. Hold on one sec. Okay. Okay, John. Well, I can't. You know what? Let me. To be really honest with you, I can't go into. John asked about the mathematics of the modified 15, and the thing is, I really can't go into it because that's really sort of the proprietary nature of the indicator. But if you look at Ninja, if you go into NinjaTrader, you will see that there's an ADX ADR line, and really what it does is it plots volatility. And the ADX ADR is going to give you an entry. And the formula that we put into the modified 15 is not that much different than a standard ADX ADR overlaid on just a 15 simple moving average. Remember, I don't believe that anything works in a second order fashion when you're looking at price action on a trading chart. So nothing here is an exponential. But it's the ADX ADR component, the volatility component, that is what keeps the modified 15 flat. Because if it was just rolling on a 15 period, and I don't want to open the NinjaTrader because it literally takes me 10 minutes to load it because I have about 25 charts open. And if I would have known that this would have gone quicker than I anticipated, I would have had it open. You would see that this just tends to flatten out for long periods of time. And I think what's key to see here is when it's flat, be very careful with your trading. When it's got significant slope degree, the probability of getting a winning trade is significantly higher, and the potential for breaking a pivot, I think, is exceedingly high. I looked at a lot of these in order to get these slides, and I wanted to make these slides that just take the real clear trades. And it really was amazing how well this predicted the break of a pivot. So I think the moving average itself is obviously an indicator of momentum. So when momentum and volatility combine to give you a nice slope, you've got yourself the potential for a nice trade or a break of support or resistance. Now, what we're ultimately going to do is we're going to find out what kind of slope degree you need, and we're going to be able to actually work directly on the candle body, create some kind of signal to give you a heads up as to whether or not you're going to break or not break a pivot. I don't think it's hard to do, and after looking at the way price moves, I definitely think it has significant potential as a really nice heads up. Aaron, these pivots can be daily or weekly. A pivot stays on a chart until it's broken. So I can't tell you how far back this pivot goes, but if this pivot went back 4 days or 5 days or 6 days, or just went back an additional hour. Once a pivot is created, you're never going to see it leave until you get a 2/3 candle break. 2/3 of the candle body has to close below the pivot in order for the pivot to break. It's a very, very unique pivot indicator in that regard. A lot of pivots break when one tick closes below it. If you don't get 2/3 of a candle body closed below, the pivot continues to trace. So it really does, it works exactly the way the Japanese intended, and that is that you need that 2/3 break below in order to cause this to stop tracing, and that's what the Japanese felt was required in order to take out all the buyers that are present at this pivot and trying to turn the market to the upside. Now there's a sensitivity indicator in the pivots. Now I have the sensitivity at 200. The bigger the number, the smaller the sensitivity. So this is going to only create pivots in major swing areas. If you set the pivot indicator to 50, you're going to get pivots at smaller swing, with smaller swings. The thing is, we have market profile, and if you have market profile and the pivot set to 50, you get so many areas of support and resistance, it becomes difficult to trade. And I think that pivots with a sensitivity of 200 have the most predictive value. If a pivot's going to hold, it's going to be one of the bigger pivots. These really small swing pivots, I don't think have much validity. And they may stop you from taking a trade when you really don't have to worry about it. So I think that 200 sensitivity is really a good sensitivity. Okay, Frank, I will digress. There's no cash quants for the CL because there's no CL cash equivalent. I mean, there's nobody trading crude oil in cash. The only cash quants we have are for the 4 cash markets you can trade, which is the Dow, the Russell, the NASDAQ, and the E-mini. Now, we're in the process of working on them. Right now, they have validity. But I think there's a problem with the upper quant, the fast quant, and the fast cash quant. We have to work on it. I do believe that there's a relevant correlation, that I'm not standing back on those cash quants. I just want to work on them until we get them perfect. You know what? I don't know what the ADR stands for. That's a really great question. Hold on a second and I'll tell you. Whoops. That's a really great question. Average directional index is ADX, and ADR. The average is an indicator used as an objective value for the strength of a trend. It is usually plotted in a chart. Here's the ADX. And let me find the ADR, because they're usually used together. So it's the average directional index. That was a really good question. I don't see what the ADX is, but the ADR is average directional range. ADX, MACD. I don't see, now the indicator is called the ADX ADR, and I don't, here it is, here's ADXR. I don't know, I can't tell you what the ADX stands for, but the ADR is average directional range. But you can see that it's measuring the strength of a trend, and it's measuring it with volatility. Let me put the slides back. And if you actually look at the indicator itself, you'd see that it's clearly a volatility. It's really clearly a volatility index. It's a measure of movement in price. Correct, Ted. Every trade out of consolidation, Ted is mentioning that every move out of consolidation is a resumption of the trend, and that is exactly correct. The issue, though, is this is consolidation too, Fred, right here, in a sense. It doesn't define exactly what our consolidation is. We define consolidation as 4 candles in a row. And in this particular case, the trend is not so clearly defined because we're sitting right at the 50. So in certain instances, it gives us a little more configurability in terms of taking a trade. Now here, if we look at just simple price action, we're definitely in a downtrend. We've got 2 red candles, 1 retracement, continue down, we never get 2 greens in a row. Our anticipation is for a short trade. We're right at the 50, and the question is are we going to take a trade through the 50 when really one of our basic principles is we only want to trade short when the 15 crosses the 50? And the answer is in this particular case, because as this formation evolves laterally, we see that there's an increase in momentum and volatility. It gives us an additional trade at a consolidation where, based on market structure and price action, the trend is not so clearly defined. This would be a clear-cut downtrend only when the 15 crossed the 50 to the downside. With the 15 above the 50, remember that we're really looking for a long trade. We want to take our trades on the side of the modified 15, and so what we'd be looking for is a bounce off the 50 to the upside. But if this consolidation of the 50 is associated with volatility and momentum that continue to the downside, we're not going to want to look for this green candle and a move back into the uptrend. We want to respect the 15 and take the short trade, if anything, to the downside. So it's an area where there's a little where the direction that you want to trade is a little more ambiguous, but that ambiguity is totally removed if we look at the 15 in relation to price action. No, Aaron, what it is the color is a combined volatility momentum signal. When the color is red, you're only going to get a red color. Remember, right here, if this was just based on momentum, you could see this clear-cut downward momentum here. And if you took price action like this and just put in a 15-period simple, that 15-period simple moving average would be really moving to the downside fast. Be tracking these candles really closely and telling you that momentum is moving to the downside. But because you require both sufficient volatility and momentum to turn this line red, it's a combined assessment where there's not only enough momentum, but there's also enough volatility as measured by the indicator and the way that the algorithm is configured to tell you that both are heading to the downside to a degree sufficient enough to turn it red. And on the entry candle, you actually get an increase in momentum and an increase in volatility to the downside. So it's a lot different than just a simple moving average, and gives you much, much more information. And I'll tell you, it was one of the first indicators that I made. And when we first made it, way, way back, like 4.5 years ago, it wasn't coded perfectly, and the ends used to fray like a piece of rope. And you could see the ADX, ADR line separate from the moving average, like a piece of rope. And then Leo came, and now Sergio, and has fixed the code. But it's one of what appears to be our simplest indicators, but it's one that gives us, I think, as much information as any of the more sophisticated indicators, like the correlative markets indicator, and now the cash correlatives that we're trying to make. I think I have started, pushing it off to the side, but it really remains a really key component of our trading strategy and trading methodology. And it's always good to go back and review because I think it really gives you a lot, a lot of really, really important information. And if you trade with it and you respect it, I think it's really going to decrease the number of losers you take. And remember, you can trade a yellow 15. And remember, you could take this trade, this pullback, and this continuation. That's a good trade. And you're trading a yellow 15. In fact, this is our perfect counter trend trade. You get a move down, a break, a quick pullback to resistance, and a continuation short. So you can trade a yellow 15 under certain circumstances, but just know that it's associated with more risk. If you trade with a red sloping modified 15, the chances of getting a win are much, much higher. Ted, that's what we need to go back and do. Ted asked about having established a minimum slope angle to have a high percentage that will continue and break. That's one of the things that's on our drawing board. Now that I used to believe that the slope of the 50 predicted whether or not, let me see if I have it in a slide. And I do, I think. And I'll show you the trade. Somewhere here, I know I saw it. Here. This trade comes up, hits the 50, and heads down. And one of our first analysis was assessing the slope of the 50 and looking at whether or not the slope directly correlated with the ability to predict a roll off the 50 and a move back to the downside. And what we found is that there is no direct correlation. That the slope of the 50 can be really, really high, and you can still get this move down and then a move right through. And we used to have an indicator called the power entry. And the power entry was related to the slope degree of the 50, and it would give you an entry on a certain slope degree, and it started to fail. For the first 6 months, it was like it was a never fail indicator, and then it started to fail, and we had to take it out. And ultimately, when we went back 2 years and looked, again, there was no correlation. But I do not believe that's going to be the case with the modified 15, because I believe that the 15 is a dual component indicator, and because it is, we're going to get a direct correlation between the break of a pivot and the slope of the modified 15, because it's not just momentum, it's also volatility. And those two independent variables together, slope and volatility, provide it with a lot of power. And you can see right here on this pullback, you're pulling back into a rising 15, and you get the move back up. You pull back into a rising 15, you get the pull back. Here you pull back, up. Here you pull back, up. Just that slope degree on the modified 15 is really important. And here's the other component that I think that's important. And that is whether it's flattening out or whether it's staying or whether it's strengthening. Now, if you remember, the MACD is based on the acceleration of the signal line away from, I'm sorry, it's based on the acceleration of the MACD line away from the signal line. When it's accelerating away, it's telling you that momentum is moving to the upside. That's all the MACD is. And when that signal line starts to come back, even when it's above the MACD line, your MACD turns. And I think we're going to find the same thing here. As slope continues to increase in number or increase in slope, we're going to get great trades. When the 15 starts to decrease, then you have to be more careful. And on a trade like this, on a yellow 15, you're going to wind up getting really hurt. And on a trade like this, where you're trading into a pivot on a strongly powerful move to the downside on the modified 15, you're going to snap this pivot and move right through. And that's what we're going to look to predict. Now, if you're very, very careful and you watch the charts real closely, you can pull this information off all visually, and you can make this prediction of a pivot break based on the slope of the 15. Right now, we don't have the metrics yet worked out, and we can't give you the signal. But these are terrific entries. Let this trade go just based on this modified 15 heading up. And it's really going to increase the power of your trading. And remembering that when you hit a pivot on a yellow 15, you're probably not going to break it. If you hit a pivot on a strongly sloping red 15, you probably are going to break it. We don't have any absolute metrics yet, but it's a great way to make an assessment and let your trades run. And the same thing is true of market profile. I wanted to bring market profile in here, although it was getting really late, and so I had to stop. But in scrolling through the charts, market profile is the same way. And I did have one example of market profile here. It's right here. This is the full platform, but all I wanted to show you was the slope of the 15 as it moves through the value area low and low volume node. It just went right through it. There's no bounce here. This is a small wick, and this just continued right through. That was the end cue. So we're going to pay attention to this on Thursday and Friday, and from now on, we're going to watch that modified 15. We're going to watch its slope really carefully, and we're going to try to use it to help us predict how price is going to move out into the future. Sometimes we're really focused on the more sophisticated indicators, and I love order flow. It's just, I don't think it's enough to reliably predict every turn in the market. And what we're going to do is we're going to bring in a dual signal, and it's going to be order flow and a cash market when we get the cash markets a little better to predict the bottoms and the tops and the entries with a little less with low probability. So we still have a lot of work to do on the platform, even though we've been working on it for 4.5 years. There's still, because it's an optimization process, and the optimization process is never done. When you look to optimize a multivariable equation, the ultimate outcome that you want to achieve is perfection, where that equation actually predicts the movement of price 100% of the time. That's your goal. It's an unachievable goal, but you can continue to move towards it and try to get as close as possible. You know, it's like it's like a parabola. You know, it asymptotes towards infinity but never reaches it. We're trying to get as close to perfection as we can, and we're working. So those are the metrics we're going to be looking at. Sergio's finishing our Sierra chart version this week, and then we can move on to all of the system upgrades that we're looking at. And one is the slope degree of the 15, predicting a break and perfecting the cash quants and using them as a dual signal. When you don't pull the candle color, right now we're just pulling it off of one line. When you need to pull it off of multiple indicators, it's a complex, becomes a much more complex indicator. So it takes him a lot of time to do that. But we're going to come up, and when we perfect the cash analysis, we're going to use one cash and in association with order flow to try to help us predict the bottoms and the tops, and we're going to see how well it does, and also the continuation trades. So we got a lot of work to do. Let me just see one thing here. Okay, I'm watching. In another room, I developed the saying concerning breaking support or resistance barrier, where we had the delta footprint. When in doubt, make the tape shout, have big numbers. Here it can be how high an angle on the 15. That's exactly correct, Ted. We're looking to see how big that slope is. But you know what the bottom line is? If you take the slope and you change the degree, does the degree correlate with the probability of a break? And you're going to be able to see that fairly quickly. Is there going to be some critical slope degree where 80% or more of your trades break? And if we can show that, then we've got a statistically significant input. And let me tell you, we're going to make it, and we're going to post it. So that's what we're working towards. And that's really what I wanted this module to be about. But the overall, stepping back a little bit, the most important thing that I wanted to show is how the modified 15 doesn't necessarily move with price. Price can stay fixed and move sideways, and the modified 15 can still continue to roll. That's the most important thing. Long sideways movement, the modified 15 continues to roll. And what we're looking for are ways to optimize our trading entries. Double pullback, modified 15 continues to move up. If you look at it, it's screaming at us to take this trade to the upside. We just have to pay attention to it. And in order to do that, we have to watch candle formation extremely closely. This is a good time to really focus in on it, because price is moving slowly. We've got very few candles. Summer volume is terrible. And also, this is when we have to be very, very conservative. Now, we made pretty decent money today. I missed a $250 or $260 trade because our electricity went down. It blows up. It's blowing up now about once every 2 weeks because it's August. It's the hottest month of the year, and we're in Florida. And it shouldn't happen in this building, but it does. So we're going to get backups to our charts. We have backups to the computer. And so if we go down the next time, it won't matter. We'll still trade through. So I hope that this was really a good lecture. It wasn't overly complex. It wasn't an enormous amount of information. But I think the takeaway points here are extremely relevant in how we trade. And if we obey our rules and watch what the market's telling us and watch what these indicators are telling us, I think it's going to help us out significantly in our trading. So, okay, let me just look again at you, Ted. In general, that's true. That's true, Ted. I mean, listen, two candles of the same color create a trend. Because look, let me show you here. If you get three candles in the same color here, it's pretty tough to take a counter trend trade. You're pretty much looking for the down move. Two candles up, you're still looking for the down move. It's really, though, I wouldn't base this right now. We've stepped away from trading dogmatic price action. We've moved to using price action and market structure. And we're really looking at the 50 and the 15. If this is red and this is red, if we get a two-candle retracement, what we want to know is what is the probability of taking the move down back into the trend. A single candle's easy. It's a no-brainer. We're going to go short if we're fairly tight to resistance, and we're not markedly oversold or not on our third or fourth retracement. When you get a dual candle pullback, this continuation is riskier. But if you would have taken the short here, you see you would have gotten stopped out. That wick would have taken you out of the trade. What you're looking for is this period of consolidation and then the move out. And as the consolidation pattern happens, the modified 15 continues to fall. That's what we're really looking for. We're looking for really low risk, high reward setups. And you can see it again here. And this is really a marked example where you would not expect the modified 15 to continue to fall here because of all the sideways action, but it does. And you get this break to the downside. So we're trading market structure, we're trading price action, but I think you have to pay very close attention to the modified 15. It sometimes moves in a counterintuitive way. You wouldn't think it would be heading down here, but it does. And when it does, it's really giving you great information that volatility and momentum are increasing even though price is moving sideways, and eventually it's going to spring price to the downside. And if you take a short trade, that's the direction to go. And here, if you didn't have the 15, the modified 15, or if you had a simple 15, the direction would be exceedingly ambiguous. In this particular case, there's no ambiguity here. You can't trade long against a red falling modified 15. So it really takes away the ambiguity in a trade like that. So that's it. If you have any other questions, just give me a call or send me an email. I'll be happy to answer it. If you need any further clarifications, what we're going to start doing next module is we're going to start to learn how to trade off the dome, and we're going to start looking at how to create automated trade management strategies. I.e., if we trade a 5-minute of Google, what should be our stop, what should be our first target, second target, third target, how to take trades directly off the dome, even though we don't need to. I do want to show you how to do it, how to take a stop limit, how to take a market order, how to take all those different trades. We're going to move more towards trade execution, and we're going to put that all together in the next module. So thanks everyone for coming, and I really do hope you got a nice takeaway message from this, and it clues you in a little bit more about how to leverage these indicators. And I just want you to know, if you don't have the software, when we finish the class, we've got 2 more. This is 7. We've got 8, 9, and 10. We're going to give you the modified 15 as your graduation present. So you don't have to buy the software if you don't want to, but you will be able to use the modified 15. And honestly, I think it's one of our most helpful indicators. And it really seems very, very simplistic, but it's a great indicator. So listen, everyone. Hold on one second here. So, you see, Ted, I don't know, and I don't want to use the background here. I want you to be able to read this without the background bias. I want you to be, I purposely put in very, very few indicators, because there's a lot of people in this course that don't have the software. And what they want to learn is how to trade price action, market structure, and just basic indicator analysis without using our software. So I didn't want to put in the quant lines. I didn't want to put in background bias, because a lot of traders don't want to use it. And listen, they're free to do that. Maybe they have another system. Maybe they have a different set of indicators. That's why I don't have it, and that's why I didn't put it in the JPEG. And this is why this is as far as I'm going to go on our actual indicators, because I want this to be a generic course that anyone can use, irrespective of whether you have our software or you don't. Okay? It certainly would have been nice if the background bias turned red and the quant lines were red, red, red. You know, that would make the trade cake. But I want you to be able to see it without them. And then you definitely will see it with them. So, okay, everyone, have a great, great afternoon. We'll be back in the room tomorrow morning. I hope everyone's there. Let's see if we can make some money. We could have made 500 easy today if we didn't lose electricity. Let's see if we can do that tomorrow. Tomorrow and Friday are going to be very, very conservative because it's August and it's going to be a very low volume day. So take care. Have a great afternoon and see everybody. Thank you, guys. Thank you, William. Thank you all. Take care. Bye-bye all.